So, as a bit of a commercial for Adagio, and for Jesse's benefit, one of the things that we have discovered is that Adagio has a great marketing program, a financial associate program, where you have the opportunity to become a financial associate. Adagio has set up the sales funnels. If you're familiar with internet marketing and sales funnels, they've got the sales funnels set up already. We've all been through it, actually. And so if you would like to help promote Adagio, if you would like to make some money as you're trying to decide how you're going to work with Adagio, then this is possibly a very good way to do it if it fits for you. And so we can go into detail on that later, but I just wanted to put it out there so that Jesse, if that's something that interests you, we can talk about that a little later on as well. Tonight, the discussion is going to be on risk-adjusted performance measures. This is the core of the apple right here. For the whole master class, that 3-hour class, the book, everything really distills down from a technical standpoint to the risk-adjusted performance measures. And we talk a lot about them. And admittedly, I'll be the first to raise my hand, I don't understand them completely. And unless I understand the math even less. And I'm a math guy. But I have looked at these formulas. I think I start to understand them. But if you expected me to teach something tonight, I'm not going to be teaching much. But I will facilitate a conversation where maybe we can kind of walk through them together, walk through some of them together, and then ask lots of questions. And your questions may not get answers, but we can certainly do our best to kind of think it through and see if we can think it through logically. So with that, I'm going to be referencing page 73 in the book, and I'm not going to go very far. I mean, we've had conversations where we've covered 30 pages in the book. Tonight, we're going to cover about 6 pages, maybe less, depending on how many questions we get. And so also, just so you know, I've been sick this last week. I'm just now getting my voice back. I'm still singing baritone, not bass, but I'm not back to my tenor self either. But anyway, my voice may give out. And so I apologize in advance if something like that happens. So with that, I'm going to throw out a question for starters and see what your thoughts are. And if not, then I will bore you by reading the book. So who wants to take a crack at defining modern portfolio theory? Anybody want to take a crack at that? And we're not gonna get on you if you don't get it just right or anything like that. So feel free to be vulnerable and go out there and take a crack at it.
I admit I'm close on this one.
Okay. I'll take a crack at it then. And like I said, I'm not sure if this is right.
And I didn't read the homework, so that's probably why.
All right. Well, Ben doesn't exactly define modern portfolio theory, but he goes around it enough that I think we've got an idea of what it is. Modern portfolio theory really is the thought behind, the philosophy behind, and the methods behind risk-adjusted performance measures. The father of modern portfolio theory, I had to do a little online research beyond the book, was Harry Markowitz. Harry Markowitz in 1952 developed the concept of beta. In other words, he was starting to work with the idea of risk-adjusted performance measures. And there's a whole slew of them, and we're going to just kind of name most of them tonight, or many of them tonight. We'll go into detail on some, and specifically we'll get into the Summers alternative risk rating, which is his matrix of risk-adjusted measurements. But for starters, I'm going to take the screen here, and I'm going to show you some things here that I think it says. Let's see. Let's see. See if this comes. I just wanted to get you into some other things that go a little bit beyond the book that maybe will help clarify a couple of things. And so here's an article that I pulled up on Harry Markowitz. Can you see that? The Financial Professionals Post?
Yep.
Okay. And it's an article about Harry Markowitz, who's designated as the father of modern portfolio theory. And so I'll just go ahead and read this real quick. Harry Markowitz's Nobel Prize winning modern portfolio theory, so there's actually a theory there behind it, was put to the supreme test in the Great Recession of 2008. And I really think this is what Ben is talking about when he pulls things back to 2008, because that's what Ben's all about, is this risk management through a series of risk-adjusted performance measures, which is based on this modern portfolio theory that Markowitz developed and for which he got a Nobel Prize. And of course, Ben proved it by making 40% plus in 2008. And so this article is saying here the same thing. It was put to the supreme test in the Great Recession of 2008. The stock market plunged nearly 40%. Stock and corporate bond markets crashed. The money markets froze up, and Uncle Sam had to bail out major banks. Now, I'll dispute that statement. Uncle Sam had to bail out major banks. But anyway, they did, while letting Bear Stearns and Lehman Brothers fail. It raised the big question: does modern portfolio theory hold up during once-in-a-lifetime events, or what Ben describes as black swan events, right? And here Markowitz, who's now something like, I don't know when this article was written. It was written back in 2011. So at the time he was 84 years old. It's now, 2021. He'd be 95 years old if he were still alive today. I don't know if he is or isn't, but if he's alive, he's 95 years old. But he made the statement. He says, it's sometimes said that the portfolio theory fails during a financial crisis because all asset classes go down and all correlations go up. Well, that's not a failure. That's basically the stress test. But anyway, he said, generally asset classes move roughly in proportion to the historical betas. He said the beta value is a measure of how risky an asset is in relation to the overall stock market. We're gonna get into that a little bit more. But I wanted you to see that there was a real theory out there, a real person, and a person who had developed the beta. And one of the things that, again, and I wish Jody were on the discussion tonight, is she's frequently asked, well, does this apply just to real estate, or does it apply to other things? And the answer is obviously, based on this, other things as well. In fact, later on, we're going to finish up with an exercise that compares the real estate market to the stock market. And so obviously, in order to be able to do that, you've got to be able to apply these formulas and these risk-adjusted measurements to both asset classes that you're comparing, right? So anyway, I just wanted to bring that article up just to underscore Harry Markowitz and the father of modern portfolio theory. And again, in a nutshell, as I understand it, he was the first to come up with beta. There's been a lot of other risk-adjusted performance measurements designed since then, and I think they all fall into this modern portfolio theory, particularly as a means of measuring risk. So, any thoughts on that before I move on? How'd I do? Do you think I addressed it?
Yeah, good summary.
Mark,
Yeah.
is there a link that I could copy and paste to go over this, to read through it?
Sure. Let me put the link to this page up there into the chat for you. Just make sure that you get it copied before.
Yeah.
See, before the end, because I don't know how well. There we go.
I usually just open it now and then I'll read it later.
There you go. There's the link to that article. Now I have some other articles I'm going to pull up for you, so I'll put those in the link. The as well. As well. Okay, let's see. Okay. I want to stress something, and I'm probably jumping ahead of where Ben is in the book, but I want to stress something so that we don't, get too stressed out about it ahead of time. And that's one of the things that Ben says here in this section. You don't have to spend a lot of time studying the math. We'll look at some of this just to kind of get our head around the formula a little bit, but we don't need to spend a whole lot of time studying the math for two reasons. Number one, there's probably more math than any of us want to get into. I'm somewhat mathematically inclined. Being a retired accountant, I'm into the number. I'm all about the numbers. I mean, I go to sleep at night, calculating compound interest in my head instead of counting sheep. So I totally get numbers. But at the same time, even I probably don't want to spend a whole lot of time trying to get into the math on this. And so a lot of people get into the master class here and they say they want to get their head around this. Okay. Well, getting your head around this does not necessarily involve getting into the math. Ben will do that as a part of the services that Adagio offers. And so we can definitely set up funds. We can definitely develop structured product or work with Ben to do that. We can definitely market our funds without having to know the math behind the risk-adjusted formulations. Okay, so put your minds at ease there. I think what is most important with respect to the risk-adjusted performance measurements is to know that they're there and that they need to be used. Be committed to using them in the due diligence. And what I mean by that is, again, then, when you get to that point where you need to have your due diligence ready to go for potential investors, have the risk-adjusted performance measurements done and have them done by Adagio. There's a charge for that. I don't know what it is, but Ben obviously doesn't work for free. But Ben also covers the point that you can charge the fund when you raise the money, you can charge the fund and get that money back. So it's effectively free that way. And the other thing is that you want to know them well enough in terms of what they're designed to do. So in other words, you want to look at the definitions of some of these. And I would recommend that we focus on the Summers matrix, the Summers Alternative Risk Rating Matrix. Because those are the ones that Ben is going to speak to the most. And so those are the ones that we probably ought to spend the most time trying to at least conceptually understand, not necessarily to do the math now, but conceptually understand what they're designed to do and the effect that they'll have on your due diligence. But if you can get those two things clear in your mind, for me, it takes a lot of pressure off. It basically allows me to focus on those things that we can do and get to the point where, okay, we've got the fund set up, we got the incredible deal going, it's all framed up, we're now preparing our pitch deck, maybe we're doing some soft pitches, and about that time is when we should be talking to Ben about the extra due diligence steps that need to be done and documented that way. Now if I'm wrong on that, hopefully Ben's watching this and he'll correct me, but the point is that he stresses that in this section very, very clearly, that we don't have to get into the math, but we just need to understand what they're designed to do. So let's continue on. A little more history. The next big thing that came along was the capital asset pricing model. And so the definition of the capital asset pricing model, let's see if I can get to that. It's the statistical method used to measure volatility of an asset relative to the market and provides the fair risk-adjusted expected return. So that's the expected return. So it utilizes beta and it gets us to the expected return. So I'm going to pull up another page, and we're going to look at that capital asset pricing model right here. Pull this open. Okay. So can everybody see that? The capital asset pricing model. Can everybody see that? Okay. And I'm just going to read here at the top. The capital asset pricing model describes the relationship between systemic risk, okay, and expected return for assets, particularly stocks. So Jody, there you go again. I'm shouting out to you. This isn't limited to real estate, but you know, the CAPM, you know, even was specially designed for stocks. But anyway, here's the formula over here. So essentially, I'm translating into English what the mathematical formula says. Expected return equals the risk-free rate plus the expected, what was that, market rate, R sub M, times beta sub I. I believe that is the positive beta there. Yep. And then minus the risk-free rate again. So, you know, there's no, we could run an example. I'm not going to try to run the example because, you know, that involves a lot of math. But the idea here is, again, you just want to understand that the CAPM model, or the CAP model, describes that relationship between risk and the expected return for assets. Any thoughts or questions there? If we had a quiz on a test, that's what the test question would be right there. You know, what's the, how do you define the CAPM there? What are your thoughts? By the way, it's the CAPM model, I believe, that Jack Trainer and Sharp developed. I think it's also with well, Sharp, Markowitz, and Merton. Oh, the four of them received the Nobel Prize in 1990 for economics. So I mean, this is big stuff when Nobel is giving them, you know, Nobel Prizes for this kind of stuff. This is big. Any other thoughts or comments before I move on?
So basically, risk versus return.
Not
always.
Yeah, the systemic risk. Now, Ben mentions systemic risk and idiosyncratic risk, but doesn't define the difference between the two. So I have no idea what the two mean in relation to each other. That's one that one of us is going to need to post, I think, in the community. And I made a post in the community today about some things there as well. But this is where, as you're reading page 73 through page 79, if you have a specific question, these are the kind of questions we ought to be posting in the community to get some answers from Ben or any other quants that might be, you know, trolling out there that could answer some of those technical questions for us. I have literally read these 6 pages probably no less than 10 times in this last week, maybe more, trying to just let it sink in, try to think about it, you know, pick up a piece here and a piece there until the pieces are coming together. But, and again, I just repeat, for somebody who's listening to this archive, you know, as you're trying to get your head around this, don't try too hard, but at the same time, try hard enough that you really begin to understand these definitions, even if you don't want to get into the math. Okay. Ben says the point of giving you the brief history is to highlight that these tactics have been around for a long time. He also introduced there Jensen, who in 1968 came up with the first use of alpha. And I wanted to bring that one into the equation. So I'm gonna go to alpha, and then I'm gonna go to the Sharpe ratio. And so in this case, do you see the formula to calculate alpha of a portfolio? So alpha is one of your risks. And there's some formulations there. You know, the alpha of a portfolio is equal to the actual rate of return of the portfolio minus the expected rate of the return on the portfolio, or the alpha of the portfolio equals actual rate of return minus risk-free rate of return minus beta times market return. So there's quite a formula there. And what he's doing is in plain English describing, let's see, I thought I had the actual formula up there. Maybe I do. Well, there it is right there, again in English. Alpha equals actual rate of return of a portfolio minus the expected rate of return on the portfolio. And then this particular one, let me bring that up into the chat. I'll put the other one up there too. This one actually has the steps to calculate it. And so I thought that was kind of fun. Well, it's not cooperating. Give me a minute. There we go. Chat. Okay, so there is the alpha link if you want to go in and play with some alpha there. And what's really cool about this one is it actually gives you some variables to play with and some spreadsheet calculations that you can look at and see how the spreadsheet is actually set up to calculate alpha. So if you go through this and spend, 15 minutes with it, you'll be calculating your own alphas and using that again with the capital asset pricing model. You can use alpha and calculate it. So anyway, I thought that was kind of fun. Let's see. We've talked about beta, we've talked about alpha, we've talked about the capital asset pricing model. And then the other one that Ben introduced was the Sharpe ratio. So here's the Sharpe ratio, and there's the formula right there. So your Sharpe ratio equals your expected value times your asset return minus your risk-free rate over your standard deviation, okay, of the excess return. So there's your formula, and you can go play with that too. The other thing that I would bring your attention to, let's see if I can do this, is that on page 74, all of these formulas are there. Let's see if I can pull that up. Okay, that's the video. Let's see if I can find the pages. On the pages in the work. There we go. Oh, that's funny. Took me off the page I was on and started me back at the beginning. Pull this up. Can you see Ben's smiling face there? We got the right page here. My computer's a little slow tonight. Guys, come on. The book, the print is so small and so fine on these formulas, I had to actually use a magnifying glass to be able to read them. I'm trying to bring them up here so that the archive file will show these. Bear with me, please. We'll get there. This is good. We're making good time. I think we'll get through this section. I don't know why this is choking. I had it all set to this page. In the workbook. And now I've not only lost the page, but it's choking when I go to find it. We're moving now. Getting closer. There we go. There we go. We're getting close. Okay, one more page. There we go. Oop. So here are the formulas that you can see. Hopefully I can you read those okay? Can you read this, the beta and the geometric mean and the CAPM and the alpha and the Sharpe ratio? Okay.
Yeah, I can.
Okay, good. That's actually easier to read than the book. Like I said, I needed a magnifying glass to be able to read some of those sub numbers, sub I, sub F, sub M, and so forth. So let's take a second and go through now some of the other terms that Ben introduces in this section. And these all have definitions. We're talking about it's on page 75, the liquidity adjusted expected return. Let's see, but before I go to that, let's go back and identify some of the other risk adjusted performance measures that he introduces. He doesn't go into the formulas on these, but clearly we can look these up online, just like we did the alpha, the beta, the Sharpe ratio, and the CAPM, and look up some of these too. But he brings forward some to consider. The Traynor ratio, that's TREYNOR, the Traynor ratio, the information ratio, R squared, Modigliani, which we're going to talk about a little bit later. We've got the omega ratio, the maximum drawdown, which we'll be talking about a little bit later, the return over maximum drawdown, the ROMAD, we'll be talking about that a little bit later, the value at risk, and the Monte Carlo solutions. Okay, so these are all risk adjusted performance measures. He's not recommending that we necessarily dive deep into all these, but I think the important takeaway here, if Ben agrees with me, is essentially that there's a lot of risk adjusted performance measures, and each one of them has a specific purpose. Each one of them is designed to handle a certain facet of risk. And some therefore are going to be, you're going to use them more broadly than others. Some you're going to use for a very narrow purpose. And again, I'm doing this as a shout out to Jody, so that she recognizes that these risk adjusted performance measures apply to a broad spectrum of investment opportunities, not just real estate. Okay, so now we were starting to talk about these 6 performance measures here. You got the liquidity adjusted expected return, which measures the break-even return of an investment given both its market risk and illiquidity. And it's only used for private or restricted securities. So again, that's one of those more specialized uses. The next one is maximum drawdown, MDD, and it measures an investment's maximum loss from its peak to its trough before a new peak is attained. And the lower the number, the better. And so that's one that Ben seems to like. The Modigliani risk-adjusted performance, that's the M2 or the RAP, and that's derived from the Sharpe ratio. M2 measures the total risk-adjusted performance of an investment as a percentage. The higher number, the better. Okay, and then we got the omega ratio, and that measures the total total positive returns over the total negative returns of an investment. The higher the number, the better. Again. R squared measures the percentage of an investment's movement that can be explained by the market. R squared of 0 is ideal for actively managed portfolios. And then the Sortino ratio. That's identical to the Sharpe ratio, except that risk is defined to be only negative and to be only negative deviation as opposed to total deviation. The higher the number, the better. So let's jump on over then to, are we kind of getting an idea of what Ben's trying to say here in these few pages? How would you summarize that? Toby or Jesse, one of you want to kind of summarize what your takeaway is on this so far?
Yeah, I'm following it. Some of it is has to do a lot with formulas and applying it to the analysis or financial analysis or risk and putting into I guess having to do with does it have is it accurate to say assets over liabilities or
Well, you when you're talking assets over liabilities, you're talking about a ratio from the balance sheet in terms of what assets you have versus liabilities. In this case, you're talking about performance. You're also talking specifically about a type of investments performance, and that takes into a lot of factors. Performance incorporates a lot of things. And when you're looking at risk, because risk is a number, risk is not a story or a relationship. It's just a mathematically calculated number. The people that have come up with these numbers, whether they be ratios, whether they be adjustments to an expected performance based on risks and those kinds of things. What you're really trying to do is you're trying to accommodate what risks you might not be anticipating. For example, you can say a certain mutual fund on the stock market is paying 12%. That's probably a little high these days, but let's just say it's paying 12%. And it's been consistently paying 12% every year for quite a number of years. But the question is, from a risk standpoint, is how real is that 12%? Can we really expect that 12% statistically, based on some risk analysis, to continue? And so that's where this risk-adjusted performance measurements comes in, because it's going to take a historical look at the returns, the performance. And it's interesting because all the regulators will look at an investment, say that mutual fund, they see that it's paid out consistently 12%. Of course, it's been all over the map, but it's and one of the things they'll say is past performance is no indication of future results, right? They have to say that. But the fact of the matter is if you've got enough data and you're using the proper risk-adjusted performance measures to analyze that data, you can get down to a pretty decent estimation of what your expected return is going to be adjusted for risk. And that's really what Ben's mission or message is. He's basically saying, hey, once you apply this properly to an asset or to a portfolio of assets, then your ability to estimate how it will do becomes much more accurate. And so, somebody may say, we're going to put together a fund. It's going to invest in real estate. Real estate's been doing, XYZ per year. So we know we can get this and we know we can do that and yada, yada, yada. What am I doing? I'm telling a story, right? Instead of saying, okay, here are the assumptions. Let's apply the risk adjusted performance metrics and let's see what we can really expect this thing to do. And that's where, Ben talks about, for example, your data stream has to go far enough back into a business cycle that it incorporates a recession like 2008 and 2009. So, we'll get an idea of how this particular investment might weather a similar storm, kind of like stress testing it, and things like that. So it's a next level of due diligence that the markets right now really don't pay a lot of attention to. He made the comment earlier in this section where, the guys that get their FINRA licenses don't necessarily have the level of mathematical skill to really calculate these formulas, and so they go uncalculated. The risk adjusted performance metrics go unused, even though they've been there for, golly, 70 years, 60 to 70 years. And so, once again, people don't understand them, so they don't use them. And that's what sets, I think, Adagio apart from so many other investment banks, so many other educational facilities and so on, because just knowing that this kind of analysis exists is enough for us to say, yeah, we better do this. We better incorporate this in our funds so that should a 2008 happen this next year, then, and we are due, and so should that happen, we can anticipate that we will be as successful as Ben was during his 2008, where he was making 40+% return. And so, and just way outperformed, in the real estate markets as well as the stock market. And so, and he's developed this particular matrix to facilitate that. And so let me segue over to that for a second. He says here at the bottom of page 75, he says, although beta, CAPM, alpha, and Sharp are better known risk-adjusted performance measures, although, he says, Modigliani, Omega, and maximum drawdown are arguably the most informative. So what's Ben about ready to say? Excuse me. And he goes on to say, as a matter of fact, those are the three we rely on the most. And so his matrix here that you see on this page is comprised of Modigliani, Omega, and maximum drawdown. Okay, and to come up with the assets or portfolios expected return. So that's pretty cool. I don't know if we're going to see this okay, but anybody have any thoughts on what I've covered so far? Any questions?
Yeah. I really like the matrix. I think that's genius, the way he lays that out and simplifies it, and it measures everything that's important and arranges it into a way that's easily understandable.
Yeah, in fact, let me just read what he wrote here. He goes, here's why, okay? He talked about, this is why we rely on those three metrics the most. He says, here's why. Maximum drawdown tells you what your potential downside is, okay? What is a straightforward and fundamental, which is a straightforward and fundamental thing to know, right? Modigliani captures both market risk and total risk as a second order measure, and Omega captures all four statistical moments, which are what? Mean, variance, skewness, and kurtosis. I can almost say that fast. Right? And so those are the things that he focuses on the most, and what we probably ought to be focusing with him as we are putting together assets and portfolios of assets. He goes on to say, As a matter of fact, I've developed a matrix that takes in all three of these metrics into account, provides one comprehensive, user-friendly risk rating, the Summers Alternative Risk Rating. So Toby, you're absolutely spot on correct. This is genius. It quite frankly, it probably ought to become a tool that we all are familiar with enough to plug in the necessary variables on the spreadsheet to be able to spit out the solutions that we need to have. And hopefully Ben will someday get a Nobel Prize for this, for just simplifying it, making it easier to use, and bringing it to a level that, quite frankly, anybody who wants to consider themselves a professional quant, at least, ought to be using. And it's interesting because it's a matrix of metrics, but who's to say you couldn't plug in three other metrics, or a few other metrics, and come up with something based on that to more accurately reflect your type or asset class. Maybe this is best used for certain asset classes. And so with all the different measurements out there, can a different combination of metrics put into a matrix like this help? I don't know the answer to that question. It's purely hypothetical. Maybe that's one Ben will want to answer at some point in the future. But you're right, Toby. This is the key right here. It all revolves around this. The whole class, the whole course, the whole book. From a technical standpoint, from a quantitative financial standpoint, centers right here on these few pages. The rest of it is how-to stuff that we can all do. But this is the core. This is the guts that makes it happen. So again, that's maximum drawdown, Modigliani, omega, and omega is the mean, the variance, the skewness, and the kurtosis. That's how I've kind of memorized that. Let me just say here real quick, I'll just add this one paragraph that Ben wrote. He says, as you might be able to gather, A1, so we're looking at the metrics. Let me bring that metrics back up. So A1 right here, let's see, is the best rating possible. B2 right here is the break-even point, and C3 is the worst, I'm assuming worst case. He says, I'm really proud of this matrix because it's the only rating ever created that captures all four statistical moments of risk, which are, again, mean, variance, skewness, and kurtosis. And he does that in a single output. And it's not heavily dependent on selecting the correct benchmark. Now that's interesting. Not heavily dependent on selecting the correct benchmark. So, with that, he says, let's play a game. Let's go over here and look at the data. And again, this is very hard to see. I can see on the screen, I can't even read it. And I can't read it in the book either. I need a magnifying glass. But here he's comparing the age-old question of, which market is better, real estate or stocks? Toby, do you have an opinion? Which is better, real estate or stocks?
I'm biased, so I'm going to say real estate.
Okay. Jesse, do you have an opinion?
I'm sorry. No, I mean, excellent points that you're making there. I agree a lot on the presentation about how Ben's theory is going to be applied to the current market. I don't know what happened earlier. I don't know if it was you or me. The screen froze.
Okay,
So
my screen froze for a while. Yeah. Okay. Well, anyway, he's collected data for both markets, for Standard and Poor, S&P 500, sorry, and the MSCI US REIT market, right? and he's comparing the data, and then he's running them through the formulations, and to see which one is better, right? And it's interesting. It's based on my understanding of the measurements. He does a lot of measurements on the REIT characteristics. He only does 4 of the S&P 500 characteristics down there. What is RS? RS was, I'm still getting some of these definitions. There we go.
Sharp ratio.
Oh, yep, that's the Sharp ratio. That's right. RS is Sharp ratio. So you got Sharp ratio, Omega, maximum drawdown, and ROMAD. Those are the 4 that he collected on the S&P. Collected a lot more data on the REITs, but I compared the Sharp ratio for both the REITs and the Standard & Poor's. Then I went and looked at the Omegas. Then I compared the maximum drawdowns, and I compared the ROMADs. And based on what I could just kind of mentally determine in my mind as far as expected returns, based on those formulas, it's kind of a mixed bag. In fact, he goes so far to say, over on the last page there on page 80, he says, you know, after you take a minute to sift through all these numbers and see if you can identify which market is better, real estate or stocks, and why, the takeaway here is that the markets are only marginally different. And that's what I was thinking, mixed bag, because, you know, some of those measurements are higher in the REITs and lower in the S&P, but the S&P has some other measurements that are higher than the REITs and so forth. And so as I'm mentally trying to arrange these in a way that lets me compare markets based on each of those measurements, I came away with kind of the same conclusion. It was kind of a mixed bag, and I didn't really quite know what to make of it. So when I got over to this page, and he validated that point by saying basically that they're only marginally different. In other words, there's not a whole lot of difference between the two. Then, you know, the opportunity, and this is the punchline of the whole joke, right? This is the punchline of the whole hour that we've spent talking about this. I love this. He says, the opportunity for significant risk-adjusted performance lies with quality active management. I mean, that's like, here we go around all of these numbers, all this number, and you know, we're getting into definitions and the whole thing. And when it comes right down to at least these two markets, you know, the REITs versus the stocks, it's quality active management, meaning that management's actively involved in selecting good assets. And you're not just, you know, throwing the dart at the dartboard, metaphorically speaking. Go ahead, Toby.
So unless you're managing it yourself, how would you measure the risk of the management, which can change? You know, you could bring somebody onto the team that isn't ethical and does something that jeopardizes a whole, you know, in real estate, that can jeopardize a whole deal
yeah. Well, what you're bringing in is really what I would consider an internal control question. Now, that's a good question for an old auditor, because we talk about internal controls all the time. And what I mean by that is essentially you've got to have controls in place that will not allow any one person to make the investment decisions. You have to bring it before a committee. The committee almost has to act, or have even a due diligence team that goes out there and does the due diligence, basically takes it through almost an underwriting process that looks at all these, you know, ratios and numbers and performance measures and all that kind of stuff, and then comes up with some recommendations for the committee then to review, and have them ask questions of the due diligence team, you know, probe into their procedures, probe into their analysis, look and see if there's any flaws in their analysis. And then as a committee, you know, they decide whether to move forward with a particular asset. And not only whether to green light the asset, but also how much risk do they want to put on that portfolio in terms of what they, do they want to bet the farm on it? Basically, you obviously don't want to do that. So, they've got to look at it, not only as an individual asset going into a portfolio, but perhaps what does that portfolio look like risk adjusted after that asset does go in at certain levels. So it doesn't become a single individual actively managing it, but it becomes a team effort to actively manage it. And as I think back, and that's a great question, Toby, because as I think back and we look at the structure of a fund, if you remember, the three key functionalities are, the technical guru, the person who basically can identify the deals and bring the deals to the table and start negotiating what that deal might look like with whoever's got the deal. You got the fund manager in the middle, and then you got the marketing or the closer on the other side. And those are kind of the terms that Ben has used. And those three functions probably need to be actively involved in that asset selection process. Obviously, the technical guru is going to be looking at it from all technical sides and probably oversee the due diligence. The fund manager is going to be looking at it from a practical implementation perspective and all that's involved there. And then the closer is going to be looking at it. Can we market this thing? Can we market this if we have to market it separately? Now, if it's part of a portfolio, obviously, that may not be as difficult a question to ask, but you still have to, you got to be transparent enough that, if investors have questions, the closer has answers, because they're definitely going to be, over investor relations. And so, I don't know if that answers your question, but from an internal control standpoint, I think that there's got to be obviously more than one set of eyes looking at an investment opportunity. And it ought to have a standardized process that you actually take it through, check the boxes, and then make your decision if you're going to go for it. And I call that active management. If the opposite were the case, and you put the fund at risk to have any one person just simply, roll the dice, that's not active management. That's gambling. That makes sense. And I'm saying that for the posterity's sake on the archive here. Any other thoughts about that comment about active managers? I mean, I had to smile when I read that paragraph because, Ben has taken us through probably the 6 or 7 most technical pages in the entire book. And then he boils it down to the punchline, and it's, by the way, it's all about active management. Which I love, I agree with. But I just thought it was kind of funny to take us through all that technical desert to get to the point where, if it's active management and you're still using the risk adjusted performance measure, don't get me wrong. But it's all about active management in the end. So anyway, I thought that was really funny and cool. The other point that he makes is just kind of wrapping up this section is he says, as an aside, and since a lot of us are in real estate, this is a key thing to remember. He says, as an aside, it's worth noting that third-party due diligence firms, in this case, it might be Adagio if we have the fund, who know real estate, and that's, that would be Adagio again, want to see a minimum 300 basis points spread between the cap rate and the average cost of debt as an indicator of the ability to perform. So when you're looking at your returns, in terms of what you're going to make as a cap rate on a particular asset and your cost of capital, there you go, minimum 300 basis point spread. Am I saying that right, Toby?
Not sure.
Okay.
Sounds right.
So sounds good when you say it fast,
yeah.
right?
300 basis points. That's
3 points.
3 points.
So if you
rate.
basically have a cap rate of say 10%, I don't know what is average today, but you don't want your cost of debt, your cost of capital to be more than 7. You want it to be less than 7%. That's your 300 basis points.
I'm always looking, okay, so the cost of capital, is that, I'm thinking
It's what-
loan to value.
It's what you're paying in interest versus what you're earning in your cap rate. In other words, your cap rate basically is converted to an interest rate. It's not an interest rate, but it's a percentage. Excuse me. Let me just say it that way. It's a percentage of your capital investment. Okay. So if you have a cap rate of 10%, you have a $100,000 asset, you better be making $10,000 a year gross rent. Right? That's a cap rate. And so what they're saying is if we're looking at these numbers and we're doing all this due diligence on these numbers, all these risk adjustment, performance measurements, all that kind of stuff, and we get down to a 10% cap rate, then we want to make sure that, so that we're not overextending ourselves, we want to make sure that our cost, our debt cost, is 7% or less. Does that make sense now?
So you're borrowing at 7%.
You're borrowing at 7% or less, and you better be making at least 10% or more on your cap
At
rate.
that point. Or if your cap rate's 8%, then you better
You're
have
5% or less.
cheaper. Yeah.
Yep, exactly.
Okay.
So he says 300 basis points, that's 3%, because each percent is 100 basis points. They fractionalize it down. So you're talking about 1 basis point is 1/100th of a percent. That's how they can get interest rates like, 5.623% or whatever, to get it out there to the third digit. Okay. Any other thoughts to wrap this up? I know it was a very technical conversation. I think we've pretty much done everything that I was hoping to get done in this section. Again, I don't want to mislead anyone. I am just as ignorant as everybody else on this. I've just only read it a few more times than everybody else. That's all. And I don't pretend to understand this. I mean, if I sat down with Ben and we had a technical discussion and he was throwing some of these terms around, I would have a general idea of what he's talking about. If he talked about certain numbers in those, I would have a little less understanding of what he was talking about, but still, I could probably keep up with him on a conversation. But if he starts getting into how they're calculated or the relationships that they have with each other, how, beta impacts expected return and all those kinds of things, you've lost me. I still have to study that. I'm not a quant yet.
Yet.
And so anyway, I just wanted to let people know that, I'm not there yet. But again, just as a parting shot, we don't have to be 100% there. If we've got the concept of risk-adjusted performance, and that we got the concept that there's a summer, adjusted alternative risk rating, and that it's a matrix of the omega, which is statistical mean, variance, kurtosis, and skewness. Yeah, I'll get that wrong, but that's omega, and that we're doing maximum drawdown, which is the most that it'll draw down in the trough between a high and the next high. And then we got the ROMAD, and the ROMAD is the maximum, and the return over the maximum drawdown. That's your return over a maximum drawdown, that ROMAD. So I'm still learning this, guys. And being able to define those. If you can just define them and have a basic understanding, that's really all Ben, I think, is expecting of us at this point. And so, go read those pages 73 to 80, and reread them a half a dozen times. Ask questions in the community. I've asked a few. I'm going to ask some more. But, if we get some community discussion going on about these specific questions, yep, pages 73 to 80 in that book, then we're going to be able to start answering those questions for each other, and we'll all learn in the process, and we'll teach each other. And that's really the takeaway that I hope you get from this archive meeting is that we really need to be engaging at this point, and engaging in the community in terms of asking these kind of questions and looking for answers and helping other people answer their questions. Even if you're, looking it up online and coming back and saying, well, here's what I found online. I don't understand it, but there it is. We'll all begin to learn more about what this means. And again, I'm not suggesting you get into the math of it. We can leave that alone for now, unless you just absolutely have to. But just spend the time understanding the characteristics and what they mean. And everything you need there is in those pages, and a little bit of online, since I showed you some stuff online. Okay. Anybody have any last parting questions or comments?
Mark, I just wanted to, you made some excellent points. This is great stuff.
Thank you.
Hopefully, Ben could do another Zoom call, or another meeting. I'd love to get in on it. And I don't actually have the workbook. I don't know if it's possible. It's in PDF, or is this PowerPoint? I'm not sure.
Yes, this workbook is available to everybody in the community. So if you go back over to, in fact, I'll pull that screen up so you can see it. Let's go back to, let's see, let's go back to this. I'm gonna take you back to a place where you know where we're at. So I'm gonna pull up the mastermind group on the calendar page right there. So you've got the community here. That's where you can make comments. You got the classroom. I'm not sure what that is. The calendar, we were just there. And if you come over to the community and scroll down just a little bit on the right-hand side, there's access the master class and the Shadow Banker secrets. If you access the master class, I believe, let me just click on it.
It's under classroom.
Oh, is it under classroom? Okay.
Yeah.
So there's the master class, right? And if you look at videos and resources, there's your workbook right there. Okay, so it's in the classroom. And you got the case study there, you got the book is there, and then the video, the 3-hour and 20-minute video is all there. And so that's the only place you got to go. Everything's there. Like I said, to get to where I am, and I'm not saying I'm much further or any further than anybody. There are people in this community that are way further than me. But to get where I am so far, I've literally watched this 3 times, and I've read the book, and I have a hardback copy of the book that I've absolutely destroyed now. I've got to go order a new book, one that's pretty that I can just keep on my shelf. But I read the book twice. In the video and the book are almost word for word the same. It's just that some people learn with the audio and the video combined, and some people learn best by reading. I do it best by a combination of the two. And so I will continue to read and reread the book and watch and rewatch this course as I come up with questions, because so far what I have found is that if I spend enough time thinking about what the material has in it, I figure out the answer 9 times out of 10. And I'll occasionally throw a question up there in the community just to see if somebody has an answer. But I've really tried hard to make a real study of this material so that I can understand it. And if I understand Ben correctly, his challenge to each one of us is to do just that. Study the material until you can teach it.
Yep.
One of my objectives, personal objectives in holding these discussions, and I hope that these discussions will grow in terms of people, because what I want to do is get to a point where, Toby or Jesse, one of you can take the topic for the night and teach it. Or lead the discussion. I shouldn't say teach it, but lead the discussion. But in essence, you're teaching it, because the person that leads the discussion, the person that's the perceived teacher, learns the most.
Yep.
You'll be amazed at how much you understand this when you start leading a discussion around it or teaching it. And so and I'm just the proverbial guy that's just trying to stay one chapter ahead of everybody else. So that what I'm saying is you don't have to be an expert before you lead a discussion or before you take a topic and share it or teach it. And so I'm going to encourage everybody to do that. And I know it takes a lot of time, but the amount of material that I've learned and that I've come to understand has been well worth it. As I'm now looking at setting up my own fund. I'm helping some other people set up funds, and being able to understand this material, and with the help of Bridger Pennington, simplify the material.
Yeah, love that resource.
We are able to, really, distill it down to where this is something that anybody can do that really wants to make the effort to do it. And so there you go. Any other thoughts or questions?
Mark, could you put the that link
This
in
link?
the chat?
Yep,
Yes.
I can do that. This is the link to that page in the community, right there. And so hopefully that'll take you over, because all the material that you've purchased in the master class and the book and all the additional resources that Ben has added to this to make it just a super value add are right here. They're all right there.
Yep.
And then these archived meetings, for as long as we can keep them up, are just an additional resource that you can go back and all I'm doing is taking the same material and hopefully distilling it down for me, what I call crayon language for myself, to better understand it myself.
I'll just say, as far as measuring risk, I don't know anybody in the real estate world that measures risk like what we just gone over tonight.
That's right. Nobody does. Nobody does. And you've got some pretty sophisticated real estate guys out there, and yet they're not doing it. So, you have to almost smile. I'm working with a gentleman in New York that has a pretty sophisticated fund he wants to put together. And because of what Ben has taught me in this, he's actually using me as a resource to help him put his fund together to make sure that this due diligence gets done. And the bottom line I have is, when we're ready to go, we're going to just take the fund to Ben and say, okay, what third-party due diligence needs to happen so that we can have Adagio's good housekeeping seal of approval on this and move forward with it. And, what adjustments do we have to make to the proposed portfolio if it doesn't measure up? But that portfolio is not going to the street until it has that third-party due diligence on it, in my opinion. And so that's where we're going with it. Okay. All righty. Well, if there's nothing else, I will say good night, and we'll see you guys next week. Next week, we're going to have the lab. We're going to have a workshop where we're going to talk about questions and answers dealing with our own projects. And so come prepared to roll up your sleeves and do a little bit of work and see if we can't make that a productive time for you. So Jesse, if you come back at that point in time, what you'll be learning is how to do this yourself, and what you might want to do if you want to start your own fund, and how all that works. And so we'll be covering that next week. Okay.
Absolutely.
All right, guys. Have an amazing evening, and
Thanks, Mark.
we'll see you next week, same time.
Bye.
We'll see you. Bye-bye.
Thank you.